Earlier on, I spoke about how VCs select investments and that a cardinal rule of VC investing is determined by the potential market size. At the end of the day, if the ultimate size of the opportunity isn't big enough to create a standalone, self-sustaining business of scale, it's probably not going to be a candidate for venture financing. As a rule of thumb, the largest and most significant international VCs will be looking for a business opportunity that's sufficiently large to be able to generate a profitable, high growth, and several $100 million revenue business over a 7 to 10 year period. These numbers would support a market capitalization of several $billion, and the returns to the VC on this investment should be significant enough to move the needle on their fund's overall performance. There are, however, smaller funds and seed investors and angel investors who invest in companies with far lower revenues and far smaller market prospects. And these numbers will differ in specific markets across the world. And in Africa, the threshold to attract VC capital is actually significantly lower than what I've just described. Sometimes an entrepreneur simply has to accept the fact that due to the limited market size, venture capital may not be a suitable form of funding for their business. They can still pursue a multi-million-dollar business, they can generate great profits, they can become wealthy and serve society in the marketplace, but they'll need to think differently about how they go about raising capital. And even where venture capital is suitable for a startup, the founders need to be prepared to play by the venture capital rules. That means sharing equity ownership, sharing board control and governance, and ultimately entering into an arrangement that's like a marriage, and it needs to last about 10 years.